So good afternoon, everybody, and welcome to this virtual lunch hosted by Pembroke with a focus on life after COVID-19. My name is David Ferrante, Vice President and Senior Account Manager with Pembroke Private Wealth Management. On behalf of all my colleagues, I would like to offer you and your families our best wishes during these challenging times. Like most of you, we at Pembroke are working from home. That being said, we are deemed an essential service, and I am pleased to report that we are fully operational and remain open for business. Our team continues to collaborate very well together, and your portfolio managers are operating seamlessly. The volatility that we are witnessing in the financial markets is caused by the high degree of uncertainty. That is why we have decided to host several virtual lunches like this one to keep you well informed. Today's call, hosted by Nicolas Chevalier, partner and portfolio manager, will give you a short market update and explain how the current COVID threat to business is also leading to interesting investment opportunities. He will also discuss how the pandemic is affecting various short and long-term trends across different sectors. With this call, we are using some new technology. Some of you have connected with us using the phone, while others have done so via the internet. For those of you using the internet, you should see us as well as our slides. You will also be able to submit written questions by clicking on the Ask a Question button, and we will do our best to answer as many of your questions as possible. Once Nicolas has finished his prepared remarks, my colleague, Dominique Costantini, will take over and moderate the question period. With that, I'd like to turn it over to Nicolas.
Thank you, David, and thanks to all of you for attending the virtual lunch today. As David mentioned, we have been doing a few of these. This is the 6th edition, so what started out as a desire to do ad hoc meetings, this is actually turning out to be a series. So thanks for attending again. I encourage you to listen to the previous 5 episodes, and we also have at least another 2 coming up in the next several weeks. Also, I would encourage you to submit feedback. We're always trying to improve on what we're doing, and any suggestions on how to do so would be greatly appreciated. Our hope, of course, is to provide you with the right information to help you make the right decisions. We'd prefer to do that in person, but I'm sure we'll have a chance to do so in the near future. As we all know, we're experiencing pretty rapid and pronounced decline in the stock markets and the economy. The markets went down a lot in the first quarter, and that was for certain indices, the worst quarter that those indices have seen. Luckily, the markets have bounced back quite a bit in early April. The first 2 weeks of April has turned out to be the best 2-week period since the 1930s. So there's a lot of volatility, with a number of new cases appearing to have reached what is a desired plateau. The governments are now around the world looking at various scenarios to reopen their economies. So today's goal is to look at the future, to try to identify the challenges and the opportunities for investors in the coming quarters and in the next year. Perhaps the best way to do so is to establish some analytical framework. Those of you that are connected on the web, you see a graph here, a multicolored graph with 4 different stages. The first stage is the pre-COVID-19 stage in green, followed by a period in red, which is the one we're currently exiting. This is a lockdown period. And then after that is a pre-vaccine and then the post-vaccine period. So the evolution from period 1 to the 2 was quite drastic and rapid. In the space of a couple weeks, the world, sorry about that. So the world essentially stopped. Retailers were closed, airplanes were grounded, and emergency rooms were emptied. The next stage, the pre-vaccine stage, is going to be much more progressive and gradual, and will likely last much longer, and most likely beyond a year. The scale of the government assistance programs announced during the lockdown has been unprecedented. They've been double what the amounts have been double what they were in 2008, 2009. And the aim is twofold. First is to ensure that there is no destruction of supply during the lockdown period. And these programs that are available come in the form of emergency loans to help businesses survive a protracted period without any cash inflows. And the other element is to make sure that the demand is there once that supply comes back online. So there have been several programs that are there to help workers by providing them with income, because these workers are going to be the consumers once supply comes back in line. As the government announced progressive reopenings of the economies, we realize that we'll realize soon that we're going to live in a part locked in, part locked out economy, this will be the case until we get to the new vaccine. Some of the key factors to consider to look at the progression of the economy is to always constantly follow how many cases are coming up. And governments have a delicate balancing act between controlling the spread of the virus on one hand and increasing the pace of the economy on the other hand. And while doing this, keeping in mind that there may be a second peak sometime in the fall. Some of the ways to accelerate the economy, there are a couple one, not only reopening of businesses, but one of the more important ones is having kids go back to school. It's not a very popular, political, or perhaps morally acceptable measure. Nonetheless, from a purely economic perspective, it's possibly one of the most important factors because it allows an increase in workforce participation. Another factor is the ability of the companies to adapt to the new environment during this pre-vaccine period. Companies will have to remain flexible and change the way they do business, whether it's by implementing social distancing measures, barriers between people, how they change their workflows in their plants. So there's a number of new processes that are likely to make them less productive, but how they're able to adapt is quite key. Another factor is how well coordinated the various governments are in opening up the different sectors. It's not very helpful if in one jurisdiction a business starts but cannot receive supply of goods from another plant in another jurisdiction just because that other plant, a supplier, is closed for business. So there needs to be some coordination in how fast and how they reopen the economy. So the return to normal is, I would think, not expected before the COVID-19 vaccine is available, and only then will consumer confidence be back to what it should be, and that various facets of the economy can return to normal. People, I don't think, will be ready to travel, go to the Air Canada or Bell Centre, or go to a restaurant with a number of people until they feel safe. There are over 100 different candidates for a vaccine. One of the more promising ones is being currently developed by Johnson & Johnson. With the help of the US government, they're investing over $1 billion, and they hope to have a candidate in phase 1 testing in the fall, in September, and hopefully approval in early 2021. This is very quick, considering that it took 5 years to develop the Ebola virus. But then again, the amount of money being deployed is quite substantial. In parallel with this development of a product, J&J is also building a new manufacturing plant in the US and adding capacity to their other facilities around the world. they would hope to have over 1 billion viruses manufactured annually. So the outcome is fairly known. It's a medical solution. What is unknown is the time it will take. We have a certain idea, hopefully early next year, but that's where most of the uncertainty is. When we look at our portfolios, given this uncertainty, we have categorized the securities in the portfolio along 3 categories. One is companies that are, because of this pandemic, facing a more promising future. 2 is the one that are seeing a neutral impact, and 3 are those that are handicapped in the future by this pandemic. So the virus has changed profoundly how we spend our money as the consumers. Some of the changes will remain, but in other cases, these changes will only be fleeting. We're testing, as I am, and I'm sure all of you are, how many different activities we're able to do online. In a few years, I'm sure we'll look back and find it funny that some of us were doing virtual gym classes on Zoom. Certainly it's fun while it lasts, but the online experience is not quite comparable to the real thing because of the lack of the social aspect. I've got kids. They find it pretty cool as well to have online classes at home, but the reality is that schools also serve an important babysitting function for many families, and therefore these things are probably more temporary than anything. So to illustrate the 3 categories that I mentioned, companies benefiting, companies who are seeing a neutral impact, and those negative, I thought we'd look at a couple examples. The first one is the traditional groceries. These companies are benefiting substantially right now during this lockdown period, seeing their sales go up quite substantially. That is due to some pantry loading, or some people call it pandemic pantry. So they're definitely building demand because of that. Also, they're taking share from restaurants as people are eating at home only, and perhaps doing a little bit of takeout, but primarily eating at home. But what we see is, as we progressively reopen the economy, the sales of those traditional groceries will return to normal. And once we face a period of back to normal post-vaccine, I would expect that those traditional grocers will grow just as they were beforehand, in line with the general population and GDP. But what also may happen is that they may actually grow at a lower pace, or face lower sales numbers coming out of the pandemic. And the reason is the online grocers, who were growing quite rapidly beforehand, has seen quite a large number of new subscribers or new consumers to their services, people that are trialing their products, and many of those will remain customers in the future. People will not stop going to the traditional bricks and mortar groceries, but if instead of going there a couple times a week, they may take 1 trip out per month or per week and do it through online grocery shopping. So in this case, one could argue that for the traditional brick and mortar grocery stores, this, even though it's a positive in the short term, could ultimately become a negative on a longer term basis. While for the online grocers, this pandemic is essentially accelerating a trend that was existing prior to COVID-19. Another example is the power sport segment. These are companies manufacturing and selling boats, motorcycles, RVs, ATVs, and other expensive toys whose purchase can be easily delayed. We've done a lot of work internally on this segment because we have a holding in the US and one in Canada in this segment. And we've looked at what happened in the 2008-2009 recession with companies such as Polaris, Winnebago, Harley-Davidson, Thor Industries, and others, and tried to understand how long it took for sales to come back. And in the best cases, it took 2 years. In the worst cases, it's never come back. And this is 12 years later. Some of those companies have never seen their sales go back to the previous level. And the learnings from this analysis are that those companies that enter the past recession with a heavy debt load had to cut dramatically on R&D, on marketing, and a bunch of different factors or expenses in order simply to survive. So when the recession ended, these companies came out of it disabled. Their products were not competitive, so they benefited a little bit from the cyclical rebound in the economy, but they never performed up to par compared to, in this case, in this example, Company A, who was able, because they had a great balance sheet, to continue to spend in new product development, and therefore when the economy came back, they were gaining substantial share. So there was tremendous economic value transferred from the weak companies to the stronger ones. So we've done this scenario analysis across a bunch of different industries, trying to understand the repercussions, whether it's from teleworking and how that impacts spending at home, use of cars, demand for office furniture. We've done this type of analysis for a number of different sectors. Some of the issues that we're thinking about that could affect also the progression coming out of the pandemic and the recession are the ones that are listed here on the next slide. And the first one is we wonder whether there'll be greater corporate caution going forward. Currently, it certainly is the case, as we're in a difficult environment. Companies are cutting costs, they're cutting capex, they're cutting, in some cases, dividends, just in order to remain liquid. But once the situation is restored, the question is whether the corporate risk appetite will return to previous levels. Our impressions are that companies may favor becoming more resilient, and even if that means sacrificing a little bit of efficiency along the way. These companies will likely review their supply chain and logistics. They'll keep possibly a little bit more inventory than they would have normally had to. They'll do business with local suppliers for certain more strategic parts. All of those bring additional costs and may mean lower margins, or perhaps trying to pass on to the consumer those additional costs in the form of higher prices. So risk management became a hot topic after 2008, 2009 for several companies and several boards, and we would expect that it's likely going to remain the case and may accelerate following this pandemic. The other important element is the growing involvement and the growing importance of governments in the private sector. It will obviously vary from country to country based on their own political system, but also based on how healthy different countries are currently. The healthier, richer countries are spending a lot more to support employees and corporations versus the poorer countries. But by and large, when we look at the various packages and government loans, when things come back, some of the companies receiving those loans will be healthy and reimburse those loans. But some of those loans may be problematic, and the governments might have tough decisions to make to either convert those loans into, in some cases, subsidies. They might have to let those companies go bankrupt, or they might have to convert the loans into equity in those companies. We're already starting to see this. The Italian government has just nationalized in the airline sector Alitalia. Dubai is injecting more capital into Emirates, while we were reading yesterday, Australia decided not to support Virgin. So the government are going to be much more present. Their actions will disrupt or likely to disrupt normal structure of businesses and industries. So that's something we need to keep in mind of. The last point on this slide is, once these programs are put in place, the governments are incurring quite a bit of debt. And the question is, when things come back to normal, what happens to all this debt? Of course, those will progressively have to be reimbursed, and that will mean either higher income tax or taxes or cut in government spending, which will put a damper into the growth of the economy in the future. So lots of factors, lots of uncertainty to think about. It's an uncertain environment, but I think it's important to return back to basics in investing, and that is invest in companies with healthy balance sheets, those that are capable of going through this prolonged crisis, or what may be a prolonged crisis, and may win a war of attrition just by being around and benefiting from other companies that are either handicapped or are stumbling. And then two is investing in companies that are not just benefiting from the upcoming economic upturn. It's very difficult to predict economic cycles. So it's important to invest in those companies because that have either a differentiated product or innovative service that are able to grow throughout a full cycle. So with that, I thought I'd switch to my last slide, which is a quote from Peter Lynch that says that the key organ here isn't the brain, it's the stomach. When things start to decline, will you have the stomach for the market volatility and the broad-based pessimism that tends to come with it? So essentially what it says is that when things look really bad, you need to stick around because the news, even though it's bad, eventually they turn positive, but it takes a good stomach to face the negative news that is coming. So with that, Dominique, I think we'll be ready for Q&A. I'll hand over the mic to you. We can't hear you, Dominique.
Apologies for that. Thank you, Nicolas. Thank you for your presentation and insight. I hear some background. You want to mute? Maybe you can mute your mic, Nicolas, please.
Yep.
Okay. So sorry, apologies for those technical issues. So again, Nicolas, thank you very much for your presentation and insights. It brings us to the question period, as we were saying. I will give a bit of color before we launch into the questions. I'll give a bit of color on the questions we received. Basically, they relate to the market more broadly, as well as our portfolios and some of the issues that Nicolas raised in the presentation. I'm also going to remind everyone that right now the Q&A is open, and those who are joining us via the web can ask questions. So I'm just pinging you with a note. So again, those on the web would have gotten a notification as to where you could ask a question. So maybe, Nicolas, before I ask you the first question that we'll start with, we've tried also to consolidate the questions where there were similar topics that were being that our clients were asking about. We've tried to consolidate those, and as I mentioned, some of them relate to the market, and some of them relate to the presentation and our portfolios. So with that said, here's our first question, Nicolas. With the pandemic and the issues with the distancing and so on, is the investment team having difficulty communicating with CEOs and management teams?
No, we're not having difficulties at all. It's just a different form of communication. we've always been lucky enough as investors in small to mid-cap companies to have access to management team. Investing in small companies is different than larger caps, because I could try to book a meeting with the Apple or Google CEO, and I would probably never have that opportunity. In small companies, we are large shareholders and important shareholders for a lot of these smaller companies. So we've never had problems talking to management teams, and it still is the case today. The only difference is that in the past we'd talk to them on the phone, and we'd go visit them on their premises, or they'd come and visit us. Now it's essentially the phone and video conferencing. So it has not changed. It might even have accelerated, but it's still good news that we're able to access management teams.
Good, thank you for that. Another question we got related to the changes that have happened in the portfolio. So you gave us some color as to, you know, the lens by which we are analyzing companies. Maybe you could give us some color as to how that has led to some changes in the portfolios.
Yeah, well, as I said, I think we bucketed the companies in three categories. The ones that are potentially benefiting from this environment, there's a neutral impact, and those that are being hurt. So we've made a few changes given the new information that was presented to us. We probably were a bit more active than usual, but we did not make any wholesale changes, because most of the companies in which we were shareholders were already very well financed. Where there have been changes is because the new environment has thrown a little bit of a curveball to some of those companies' business plans. And let me give you perhaps one example. We were shareholders of a company based out of Toronto called Parklawn. Parklawn is a company that owns cemeteries and funeral homes. This is a business that historically has been surprisingly counter-cyclical. In the last recession, as people were wondering about what to do with their services in an economic downturn, they feel a little bit more vulnerable. They wonder whether their kids might have enough money to prepare funeral services. So typically what happens during downturns is that people purchase funeral services on a pre-need basis. And our expectation was this might have been the case again this time around, but given the inability to sell those services, it's much more difficult. You know, it's tough to sell a service for anyone in business development these days through the phone or just through Microsoft Teams like we're doing today. So the company is proving out to be much more cyclical than it has been historically. And combined with the fact that there was management turnover, the fellow that built the business moved on, was replaced by a new management team based out of Houston. We felt that an environment where everything is changing, it was perhaps not the right time to accentuate the change with internal changes as well. So that's an example where the company was a bit more levered than we thought. The operating risk was enhanced because of the inability to change, to sell, and also change in management team. So that's one example of a company we sold. We're adding to new position or buying new companies as well. Companies that we had been looking at for a while, that we loved the business plan, we love the people, but we're waiting for an entry point and got a proper entry point with the stock market declining. One example that my colleague Matt Beckerleg purchased recently is a company called Five9, which provides call center software for those call centers that have people working from home. So clearly they're definitely benefiting from this environment. We're adding to existing names. There's a company we've had in the portfolio for 25 years, a company called Richelieu Hardware, based in Montreal. The CEO has been there for over 30 years. The company has no debt, has excess cash, and historically has taken advantage of market downturns and economic downturns to be aggressive acquirers of businesses. So we expect them to make a number of acquisitions in the next year or so, trying to take advantage of other companies playing defense so that they can play offense. So those are examples of what we're doing, Dominic. Sorry for the long answer.
No, that's great. That's great. I think people appreciate more information than less. So thank you for that. Another question that we had submitted by email related to sectors. So in the same vein as what you just described in terms of specific companies, could you speak to sectors and how the portfolio sectors are represented currently in the portfolio?
Well, as growth stock managers, we're always going to be exposed to certain sectors that offer more potential growth, and that's typically information technology, healthcare, consumer spending. So when we look at our portfolios for the last 10, 20, even 50 years, those are the sectors that are always heavily represented in the portfolio. These are not top-down decisions. We're not sector rotators. We don't make decisions on whether we want to overweight one sector or be more exposed in one sector or the other. These are truly decisions based on opportunities from the bottom-up perspective. So we look at a number of different companies and try to find those that are most attractive to us. And if it so happens that there are more of them in technology, which is the case, then we'll have a greater proportion of holdings in the technology sector. So those three sectors have always been and will continue to be important sectors in the portfolio. The technology sector has gone up a little bit in the US and Canada because those stocks have performed a lot better in this downturn. But we try to run diversified portfolios.
Right, correct. Thank you. Did you want to comment? I'm sure it's on people's minds. And when we did get a specific question on that through the Q&A, the live Q&A, related to energy. And I think in other such lunches, we've mentioned that we came into this with very low exposure to energy, no exposure to materials across all portfolios. Maybe it's worthwhile sort of refreshing status related to those two sectors, Nicolas.
Yeah, well, you're correct. We have very little exposure to the energy or direct exposure to the energy sector. Energy affects many industries, but the direct exposure is essentially nil in our US portfolio and nil in our dividend and growth portfolio. There is one holding that's about 2% of the Canadian growth portfolio company called Pembroke, which luckily has a much lower cost structure on a per barrel basis than many players. Yet they're still struggling in this environment, but the exposure, you're correct, is direct exposure is limited. Having said that, we think about, just as I was saying about the implications of everything with regard to the pandemic, we're also thinking about the implications of a lower oil price and what that impact may be on other holdings. And certainly for certain companies, it will be a benefit. It's going to help the consumer for sure. Companies that may offer products that need to be packaged and shipped. I'm thinking of a company called Jameson Wellness, which makes, as many people probably know, vitamins and nutritional supplements. They have plastic packaging. Those products need to be shipped across Canada and internationally. Those companies are going to benefit from a lower oil prices. At the other end, any company dealing in Alberta, whether it's a retailer or whether it's a financial services firm, will be impacted if oil prices continue to stay low on a sustained basis, and some of the E&P companies have to cut back on production and staffing and whatnot. So there's some direct exposure and indirect exposure, Dominic.
Thank you for that color, Nicolas. We had another question come in, and it takes us back to our interaction with CEOs and management teams. I published that question in the live Q&A, and it speaks to our interview skills. So the direct question relates to, is there a risk having a close relationship with management teams? They will likely tell you what you want to hear so that you remain invested. So anyways, I guess this speaks to our interviewing skills and the experience that the team has. And it's not just now, it's all the time, right? That company CEOs and executives are trying to sell you their stock in many respects. So maybe you could comment on that, please.
Yeah, no, it's a good question. And it reminds me of a trip that my colleague Doug and I took to New York 2 years ago to go take a course on interviewing skills. And the course was given by 2 ex-CIA individuals, and they applied their knowledge and their experience and gave a course on how to interview CEOs of publicly traded corporations and what to look for, whether it's the wording, the body language. But I think one of the important lessons was preparedness. And as you prepare for a meeting, there's certain answers you want to have specifically, or certain questions you want to have specifically answered. So part of it is how well prepared are you going into a meeting. With regards to being too close to CEOs, it is always a risk. If you've been a shareholder in a company for a long time and the CEO's been made money for you and your clients, there's always a risk of falling in love. And when dynamics change, you may give that management team a little bit too much slack when the environment has changed. So we try to counterbalance that by the fact that when we do our work, we're constantly polling not just management teams, but also third parties, whether it's trying to get a better understanding from competitors, suppliers. We make heavy use of what's called expert networks, which are firms that help us put us in contact with people in a given industry, so as to get third-party checks and third-party opinions on a given industry and company. So that is one of the mitigating factors. CEOs are definitely good salespeople, and we see that particularly in the US, where not only are they good speakers, but they have good PR staff that come up with great presentations and way of saying things that is attractive to shareholders. So we have to be cautious. Perhaps the last element that may help mitigate it is that we've always talked about alignment of interest at Pembroke. It's not just the fact that the managers and the employees and their families are large shareholders in the units we manage for our clients, but also we invest in companies where the management team is also a large shareholder of their own companies. So we're not just investing in companies where the CEO is just an option holder that can benefit only from the upside in the stock, but not on the downside. These are CEOs that are in there for the long run, will benefit not only on the upside, but also on the downside if bad things happen. So they tend to be a bit more balanced in their comments and their observations as we talk to them.
Good, thank you for that, Nicolas. I would add also that there's 2 PMs on every stock, so that also is another dynamic that helps to mitigate any one individual, as you said, quote unquote, falling in love. We got a question related to know your client, and I published that one. So maybe you can take a bit of a break, Nicolas. I'll handle this one, if you may. It's here. I'll just read it out for those who are not joining us by the web application. This investment environment addresses the critical importance in knowing your clients, keeping that information current. Is that an annual process for most portfolio managers? First of all, that's a very good point, and it's valid. Certainly, I think that's the minimum requirement. We stay in touch with our clients, and certainly if there were, at any point in time, if a client situation changes, we want to make sure that the investment portfolio he has with us is suitable. So yes, that said, we also counsel people not to make dramatic changes to portfolios in times of stress like this. So it's really the client's circumstance that needs to have changed, not the markets per se. And so that's what would drive that conversation. But certainly, if anybody on the call, any client is concerned about their circumstance, if it's changed, if they want it to be, certainly give us a call your rep, your Pembroke representative, and engage. So anyways, I think that gives you some color there. Thank you for that question. It's another very good question. Another question that came in, Nicolas, it relates to potential changes going forward. So I think you've made it was very clear, again, how we are looking at industries and stocks, and you've mentioned a few changes. We always have a pipeline of stocks that we are considering as a firm and each portfolio managers. Is there anything that we are considering? I guess it's tough to say, but maybe you could comment on that.
Well, the current situation is quite dynamic, and it may worsen. It could improve. We need to keep following it. It's a full-time job. That being said, there are stocks in the portfolio, as I said, that are benefiting tremendously. Others are neutral, but that neutral may turn negative if things are prolonged and take longer than expected. One of the areas that is struggling the most right now is retailing. We have 4 stocks, 4 retail companies, 4 retailers. One is doing quite well. It's a company called Good Food, which is in the meal kit and meal solution online retailing business. So as you can imagine, that business is not a problem right now. There is another company called Ollie's, which we just purchased in the US. They are essentially a closeout retailer. So when a Procter & Gamble produces too much product, or whether another retailer who's closed right now and has got tons of inventory with more to come, there's going to be a lot of excess inventory in the system, and a company like Ollie's will take advantage of it by buying that excess inventory at 10 cents on the dollar and selling it at prices way below what those products were sold at Walmart. So those are the 2 ones that are doing well. Ollie's is still open and will have tremendous opportunities going forward. There are 2 others that are more problematic. One is Sleep Country Canada, or they run their banners as Sleep Country across Canada, except in Quebec where it's Dormez-vous. They are likely to benefit from this environment because 40% of the industry is composed of independent mom and pop retailers. So I would expect some of those mom and pop retailers to have a hard time, and some of them to disappear. And Sleep Country, being the dominant retailer of mattresses and accessories, sleep accessories across Canada, will stand to benefit from the demise of some of those competitors. But if the situation lasts a lot longer, then it becomes problematic for the entire industry, from the weak players as well as the strong players like Sleep Country. The other one problematic retailer is Aritzia. The last thing people are doing right now is buying clothes to work at home. They still have some stores open in certain select locations in the U.S., but the majority of their stores are closed. They still do commerce online, but the situation is difficult. They have excess cash, and they can withstand, again, a prolonged period. But if it lasts a lot longer, if for whatever reason a vaccine only comes out in 2 or 3 years from now, people are not going to go to malls anytime soon. So the situation is dynamic, so we always constantly have to revisit existing holdings and assess new information as it comes along.
Thank you for that, Nicolas. I would add, if I could, just to frame, whether it's Aritzia or Sleep Country or companies that are, particularly affected. We across our portfolios, there's roughly 100 stocks, 100 companies that we're invested in. So obviously there will be, it would be an incredible stroke of luck to have none, 0 companies in our portfolio not be affected by some closures and so on. That said, the team is comfortable that there are no liquidity issues, and these companies that we own will we can look through the valley and they will come out hopefully as stronger competitors, gaining share in that example that Nicolas showed. So I thought just to frame that, we have a few, but relative to 100 stocks, and those that we own have good balance sheets. Nicolas, we have a question that's come in through the Q&A. It's a bit too long to read, but it takes us back to government intervention. And by and large, given that we invest in Canada and the US and those economies are interlinked, it asks the question, to what extent are we comfortable? And I think you referenced this earlier as well in terms of regions. It's one thing to open up a region, but across North America, there's a lot of supply chains that are coordinated. And I guess the question is asking us, how are we comfortable that governments will be coordinated in addressing kind of reopening? I guess I would say, I'll turn it over to you in a second, but I guess I would say that it's in everybody's interest to have a coordinated approach. It's uncharted waters, so it's difficult to see. But of course, when anything that's political, that has a political dimension, there's always a risk. So I don't know that.
Yeah, unfortunately, the bad news is every situation in every country and even every state in the US is different. And even here in Quebec, in the province, Montreal is a lot different than the region. So the talk right now, at least in Quebec, is perhaps to have the regions open up sooner than later, or sooner than in Montreal. And we're seeing that in the US as well, where the southern states are opening sooner than perhaps New York is. So I think it's very difficult to have everything open on a coordinated basis. I think there's an effort to do so, but realistically, it's not easy. But instead of delaying everyone to make sure that everyone is ready, what they're doing is proactively opening those areas that are open. So that's the good news.
Okay, thank you for that. We now maybe turn to some questions on the markets. I'm looking at the time, and we've got sort of roughly 10 minutes to go. One related to, what level is the S&P trading at from a PE, and how does that compare historically? I think I'll turn it over to you in a second if you have. But other companies have
My audio is no good, Dominic. I can't seem to hear what you're saying. I think.
I don't know if you can still hear me.
Okay, I think it's a bit better now. Maybe if you turn your video off, if that's okay, the quality of the audio might be better.
Yes, I think you lost me for a moment there. Apologies.
Yeah, I missed your question.
Oh, you missed the whole question. Oh,
yeah,
okay.
It might have been your best question yet.
No, well, maybe not. So I guess with time moving on, last couple of questions on the markets. One relates to the level the S&P is trading at, and how does that compare with historical PEs? I think that's a bit of a tough one. Getting a handle on the E, I'll turn it over to you in a second, but getting a handle on the E is an issue. A lot of companies have withdrawn. So I don't know if you want to add anything to that, Nicolas.
No, that's a good point. I mean, the E is very uncertain right now. The E will likely be 0 this year, and negative for some companies, but I think you have to look out at 2021 to get a better handle on the E. So the only way perhaps to try to get a handle on current valuations versus historic ones is to look not only on a price to forward 12 months earnings, but on a price to a trailing 12 months earnings. We know what the trailing 12 months earning is. I don't know precisely what the PE ratios are, but the last information I saw is that we're selling at a premium to the previous recessionary PE ratios on a trailing basis, and does not necessarily mean that markets are necessarily more expensive today, because you have to take the environment into context. Current interest rates are at 0%. Which was not the case in the last recession. So markets are always priced versus what other alternatives for investing are, and stock market will always trade at a premium to the bond market. But if the bond market is at 0% rates right now, that means the stock market can be a lot more expensive.
Good, thank you for that. So maybe we can end on this next question, also related to the markets. It speaks to the business press suggesting that the recent run-up from the March lows might be short-lived, and we might be testing those lows. So if you have your crystal ball handy, Nicolas, maybe you want to see what it's suggesting.
Well, my crystal ball is not very good to predict the next 6 months, okay? It's probably better at predicting the next 3 to 5 years. When I look at sources of return in the stock market, it comes from three areas. One is the dividend, the next one is the earnings growth, and the third one is the PE, okay, or the valuation or the price at which investors are willing to pay for earnings. So the first one is dividends. If someone is buying a stock that pays a 2 or 3 or 4% dividend yield, normally that's money in the bank, and there's very little risk that will not be the case. So that's a start. The next one is earnings growth. Earnings, as I said, this year are going to be depressed. But if I look out over the next 3 to 4 years, I'm convinced that the earnings are going to be a lot greater in 3 to 4 years than they are currently. The last point is the multiple. The multiple in the short term is very volatile and is subject to psychology, emotions, and is essentially not predictable. And in the short term, it's the P and it's the psychology that drives returns. And that's why I cannot predict over the next 6 months whether we've hit the bottom or not. What I'm encouraged is that if I look out the next 2 to 4 years, not only will we benefit perhaps from some dividend earnings growth, but the current entry from the P ratio is quite attractive. So that's why I'm not willing to answer directly your question whether we've hit the bottom in the short term. I don't know, but I'm I'm encouraged by that. Over the next 3 to 4 years, this is probably going to turn out to be a good entry point.
Great, thank you for that. Well, that's a nice note, I think, to end on. So, Nicolas, thank you again. More importantly, thank you to all of you on the call for having joined us today. Of course, if there's any questions that we haven't addressed, if you have any follow-up questions, by all means, do reach out. As Nicolas was mentioning earlier, we want to engage with you on what's now become a weekly basis, and next week will be no different. We will host another event, and as we continue to provide insights and exposure to various members of our team, next week we will have Andrew Garshigan. The call will be on Wednesday, April 29th. Wednesday, April 29th will be our next call. The invitation will be circulated probably this afternoon after this call. And Andrew will be, he is the partner and lead portfolio manager for the Pembroke Concentrated Fund. He'll be reviewing that strategy, providing an update, and focusing on risk management disciplines within portfolio construction methodology. And I guess that concludes our virtual lunch. Again, the presentation, today's presentation, will be available on our website, as well as the other 5 presentations or virtual lunches that we've made. So you can find it again and on our website, that is. So on behalf of Nicolas, David, and myself, and the whole Pembroke team, thank you very much for having joined us. And I guess stay healthy, and we'll see you next Wednesday. Thank you very much.
Thanks, everyone.